Long-term care insurance sounds like the responsible adult move, the kind of thing your financial advisor mentions right before you stop listening. But what if skipping it means watching your entire retirement nest egg vanish in roughly 2 years of nursing home bills? We're talking about a crisis hiding in plain sight. Because the average nursing home now costs over $100,000 a year, and Medicare Surprise barely covers any of it. About 70% of people turning 65 today will need some form of long-term care, and most have absolutely no plan for how to pay for it. The industry was once booming, with insurers practically handing out policies like candy at a parade, betting that premiums would outpace claims. Then reality hit. People started living longer, investment returns shrank, and insurers hemorrhaged billions, causing over half the major carriers to exit the market entirely. Think of it like buying flood insurance after a drought for years. Nobody thought they needed it, and then the water came for everyone at once. Premiums on existing policies have skyrocketed by as much as 80 to 90% in some cases, leaving policyholders furious, confused, and locked into impossible choices. The psychological whiplash here is real. You did everything right. You planned ahead, and now the insurance company is basically charging you double for the privilege. Experts like financial planner Michael Kitces have pointed out that traditional long-term care insurance is, quote, a product in crisis, yet advisors still recommend it for the right client at the right price point. Here's the dirty little secret the industry doesn't love to advertise. This is a classic actuarial miscalculation wrapped in a fear-based sales pitch. The insurers underpriced risk for decades, and now you, the consumer, are essentially being asked to bail them out through premium hikes. Long-term care risk follows the same pattern as every other late-life financial hazard, ignored until it's personal. Then suddenly, the most urgent conversation in the room. Reddit forums and financial communities are split down the middle, with half shouting, self-insure if you can, and the other half sharing horror stories of families wiped out by memory care costs alone. Let's bust the biggest myth, that Medicaid will just catch you if you fall. Medicaid will catch you, but only after you've spent down nearly all of your assets, meaning your legacy, your spouse's security, and your dignity are all on the table first. The more rational play, historically speaking, is a hybrid approach life insurance policies with long-term care riders or short benefit period policies that cap exposure without leaving you fully naked. You're not trying to insure every dollar of potential care costs. You're trying to insure the catastrophic scenario where care stretches for 5 or 6 years. Position size matters more than conviction here. If a policy premium would strain your monthly budget or require liquidating investments, that policy is already working against you. The discipline is in buying only what you can sustain without resentment, and then staying consistent without letting fear or optimism override the math. There's a certain absurdity in paying $2,500 to $4,000 a year for something you hope you never use, but that's literally the definition of insurance. And somehow we all accept it for our cars and homes. The philosophical reframe is this: long-term care insurance isn't a bet on getting sick. It's a bet on keeping your choices intact when you're most vulnerable. Whether you end up needing a memory care facility or aging gracefully at home, the families who navigate this best are the ones who made a rational decision early and didn't leave it to chance or guilt or a panicked call at 78. Discipline, right sizing, and consistency aren't glamorous, but they're the only things that actually work when the stakes are this high. And if you're ready to take that same disciplined approach to building real, lasting wealth, check out our links in the description below, where we can help you get started, whether in real estate investing, home contracting work, or finding the right lenders.